Good morning, good afternoon, and thank you for being here. On behalf of Silicon Valley Bank, it's my pleasure and honor to welcome you to our third annual webinar and panel discussion on the future of climate. I'm Dan Baldi. I'm part of the climate tech and infrastructure team here at Silicon Valley Bank, and at SVB, we strive to be the bank and financing partner of choice to the innovation economy. On the climate team, we provide banking services and debt capital to the sector. But for us, it's more important than that. We have the privilege of partnering with and working alongside a great group of entrepreneurs and investors who are developing and deploying amazing technologies to decarbonize our world. They're working hard to make this a better place for all of us and for those who come after us. And it's an honor and a privilege to help in our small way. So if you work in the sector and you want to talk about what we might be able to do to help, or if you want to talk about the realm of the possible, we would love for you to reach out. Give us a call. We'd be happy to connect. Let's press on. Next slide, please. Housekeeping items, the most important of which is we hope you'll join in this conversation through submitting questions. We have a Q&A function. If questions come up during the conversation today or from the slide deck, we'll hope that you'll submit them and we'll do our best to get to them at the end. Next slide, please. The agenda for today includes a brief overview of selected highlights from our Future of Climate Tech report for 2023. We published this report last week. It's available now on our website. If you haven't had a chance to see it, you can download it there at svb.com in the Trends and Insights section. Following the report highlight, we'll transition to a panel discussion with some really fantastic experts who have agreed to join us today to share their thoughts about the report, about what's going on in the sector. Next slide, please. Our panel will be led by Alan Neuhauser. Alan is with Axios. He does a great job of covering climate tech deals for Axios. If you haven't had a chance to check out Axios, it's a really solid news platform with great coverage of the tech sector and great coverage of climate tech specifically. I'm an Axios subscriber and I recommend that you check it out. Also joining us is Fritze. Emily is a partner at the Wesley Group, a Menlo Park-based venture capital firm that's been investing in climate themes for a decade and a half. Emily's very experienced in the climate sector. Prior to joining the Wesley Group, she was at Powerhouse Ventures, where she helped them raise their inaugural fund. And before that, she worked in the Obama White House on climate and energy policy initiatives. We're also being joined by Shayle Kann. Shayle is a partner at Energy Impact Partners. He leads EIP's Frontier Fund, which is dedicated to investing in revolutionary technologies to enable deep decarbonization. He's active in policy and in advising on climate-focused investing and is a thought leader in the media as host of the excellent climate tech podcast, Catalyst. So very excited to have these great people joining us today. Next slide, please. Some of the key themes that we're going to talk about today are themes and policies impacting the sector, current market conditions and financing dynamics, and the broad and expanding nature of technology in the space. Next slide, please. Next slide. Over the last few years, we've noticed a marked resurgence in public, investor, and government interest in the climate sector. Perhaps the most profound example of that is the U.S. government's passing of the Inflation Reduction Act, a $292 billion commitment to advancing the development, manufacturing, deployment of technologies targeted at reducing our carbon intensity. And it's not standing alone. Together with the CHIPS Act and the bipartisan infrastructure bill, they represent an unprecedented national commitment to supporting decarbonization and modernizing our infrastructure over the next decade. If you look at the upper left chart on this graph, you'll see U.S. greenhouse gas emissions, and we count our gas emissions in gigatons, and gigatons is just fancy jargon for a billion tons. What you'll notice is in our run rate in 2020, we're about 5.5 gigatons per year. And the Brookings Institute estimates that the impact of the IRA will help us to reduce that emission by roughly 1.5 gigatons, 1.5 billion tons, which is really impactful. And we're in the early stages. No, please go back. We are in the early stages of several profound megatrend shifts that are really all around the climate tech sector. And the first of those shifts is the modernization of our electrical and power system, the rise of renewables. The second one is the decarbonization of our transportation and industrial sectors. And the final one is the modernization of our food and agricultural systems. Climate tech is at the heart of all of these changes, and the opportunity to upgrade and improve these enormous parts of our economy is a profound one. The impact of the Inflation Reduction Act on the acceleration of these changes is one we applaud and support. So despite the choppiness and the noise in the broader capital and venture capital markets, it's our belief there's significant financial opportunity in the climate sector as we focus on national and international adoption of climate technologies to improve our environment. Next slide, please. This is a Gartner hype curve, and it shows technology progression along an arc of initial enthusiasm, followed by the trough of disillusionment, and ending up at what is called the plateau of productivity. And one of the things that we've noticed at SVE after being involved in the industry for about 15 years is that we've had the benefit of having sort of a courtside view of the development, the maturation, and the deployment of some amazing technologies. One of the lessons learned over that time has been that it takes a long time to develop deep tech, hard science innovations and to deploy them at scale. Yet year over year, we see technologies march along these curves. We note this year anecdotal progress at the early stages in advanced nuclear and electric air transportation and green hydrogen. We note mid-stage development in alternative proteins, battery recycling, carbon markets, and we note late-stage advances in demand response, energy storage deployments, electric vehicle adoption, and of course, the rapidly scaling deployments of solar, wind, and storage. Next slide, please. So now we're going to switch to talk about venture fund fundraising. In the upper left quadrant on this page describes climate fund investing. The blue bars are trailing 12-month quarter-over-quarter progress in venture fund announcement, and there are a couple of things to note. First is at the end of 2020 and the beginning of 2021, these periods were a particularly robust time in capital markets in general, and in the VC and climate VC markets in particular. Climate tech fundraising reached an all-time peak, both in terms of the number of funds announced and the size of the funds committed during that period. Anecdotally, during that time, there were lots of SPACs going on, and it seemed like new funds devoted to climate were being announced week over week and month over month. Since then, the broader capital markets have experienced choppiness, and climate funding has cooled dramatically. We returned roughly to the investment phase or the fund formation phase of late 2020. And although this cooling has impacted the market fairly significantly, we still see continued activity. A couple of points to that. One, fundraising is down roughly 60% as indicated by this red chart. But the activity in the sector is dominated by the most active firms, and the top 5% of firms represent more than 1/3 of all of the fundraising activity. You can see in a lower left quadrant, there has been a decrease in the number of firms active in the fund or active in the sector. Active firms are defined as firms who have made at least one investment in the last 12 months, and we do see drop-offs in funds participating in climate and drop-offs participating in general tech funding as well. Despite that, the most active funds, anecdotally, we speak to many of the funds listed in this upper right quadrant, and they all remain very interested in making investments in the sector and actively looking for opportunities to deploy capital. So the good news, as highlighted by the lower right chart, is that climate tech funding, as normalized, has outpaced general tech funding by a significant margin. Next slide, please. Flipping from fund fundraising to portco investments and individual company formation and investment making. We do see a corresponding decline in 22 and 23 in the pace of dollars invested and the number of deals done. But it's easy to see that the slope of this curve is not nearly as steep as the curve on the preceding page. In fact, venture fund fundraising experienced a decline of roughly 60% year over year, but individual deal making has dropped by only about 20% year over year. The upper right chart shows the investments in subsectors from least impacted to most impacted, with mobility and industrials having the least slowdown in investment activity, and fintech and food tech having the largest slowdown. It's easy to note that fintech in particular is experiencing some regulatory and fraud-related concerns that are leading to a slowdown in investment pace. So while the fundraising market has cooled quite a bit, deals are still getting done. And investor sentiment continues to indicate that there's reasonable opportunity in the sector. And in addition to that, there's quite a bit of dry powder on the sidelines looking to be deployed in the sector. On the lower left chart is actually my favorite bit of analysis in our report this year. This part of the report is highlighted to show, the valuations in our sector, in the climate tech sector, as compared to general tech. And we've postulated over time that the robust public interest, investor interest, and government support in the climate space might provide a buffer for climate tech companies. And this chart seems to support that thesis. You'll note that valuations are up year over year across the board. Certainly not every company experiences an up round, but overall valuations in climate have been up year over year. And that's a stark difference from general tech, which you'll see in the gray color. And post seed round, those are down across the board. So there is a market difference. And we believe this difference is due to the continued robust interest and commitment to investing in the sector and market opportunities represented there. We also continue to see significant valuations. The incidence of unicorns in the sector continues, and we're pleased to see that. I think year to date in 2023, there have been roughly 10 unicorns. As recently as last week, Kobold Materials, I think, announced its new round at an impressive valuation. So we'll touch on valuations again later in the slides ahead, but that's encouraging. Next slide, please. Flipping to later stage infrastructure and project finance. Just a quick asterisk to note that SVB also has a project finance division that supports the deployment of renewable energy projects in the sector. But the good news here in the upper left chart is that default rates on green projects are distinctly lower than non-green projects in the sector. And this is a really encouraging sign. It's great for scaling and facilitating continued access to capital for climate technologies as they enter the market and need to be deployed. So that's very encouraging. The bottom half of this slide circles back to the role of government in the sector. We're very enthusiastic about what the U.S. Department of Energy is working on in the form of the Loan Guarantee Program. The Inflation Reduction Act expanded the scope of the DOE program, and it's expected to amount to more than $400 billion in new loan commitments over the next decade. That's very encouraging. Jigar Shah at the head of that organization and the great group of people that he has built and assembled at the DOE are bringing a very competitive and diligence-focused, while yet expedient approach to evaluating loan opportunities there. The pace of new loan commitments is about to jump off the charts as that team moves loan applications through their pipeline and process. And you can see on a lower right adjunct chart that the number of applications in the last year has doubled from roughly 69 billion to over 120 billion. So lots of new technologies being evaluated and put through the review and diligence process there. And we know from historical incidents not so long ago, highlighted in the EV space here at the left side of the chart, that the loan guarantee program has been very impactful in helping move and empower new technologies in the climate sector as they come to market. And so we're really looking forward to watching the development and deployment of these funds and the impact that they make in the sector. Next slide, please. Data keeps the lights on. This is a theme that I think really is broader than that, but the point is that as technologies mature and scale, the amount of tech required to integrate them and optimize them in the systems that we enjoy expands dramatically. And as an example, electric vehicles. We'd like to highlight. Electric vehicles are fairly simple at their core, fairly basic. You need an energy dense battery, you need an energy efficient motor, and you need an aerodynamic shape, and you can make an effective electric vehicle. But once we begin deploying EVs at scale, you need a lot more technology to effectively integrate them into the electrical system. We also need advances in mining, in grid integration, in autonomy, in telematics, and fleet optimization, and two-way charging, and demand response, and machine vision, vehicle-to-vehicle communication, and vehicle-to-infrastructure communication. The data stack that EVs can produce and the tech stack required to integrate them successfully into our lives and environment is pretty dramatic. And there's just a lot of opportunity as technologies are brought to market on scale. And while EVs are an example of this, they're not the only example. Certainly, integrating renewables into the grid and modernizing our industrial processes will require similar expansions of tech beyond the basic core technology. And this is one reason why we at SVB remain incredibly enthusiastic about the outlook for the sector and the opportunity and role for technology to improve our lives. Next slide, please. Green hydrogen levels up. This is the last theme from the report that we'd like to touch on. And green hydrogen has amazing potential to decarbonize our industrial processes and long-haul transportation. And on the tech development front this year, we've seen some amazing progress and advances on the production side, but we recognize that we need just a massive amount of investment in manufacturing infrastructure and distribution infrastructure to make hydrogen at scale, both at cost parity with fossil fuels, but also to get the hydrogen where we need to use it. And the Inflation Reduction Act has done a lot to reduce the cost of green hydrogen. You can see in the upper left corner the impact of tax credits, over time, reducing the cost at parity or even to below parity with fossils, and that's encouraging. So we continue to see strong VC investment in this subsector, both on the production side, on the storage side, and the transportation and application front as well. We expect to see continued strong tech development progress in the coming years. And that's exciting as these technologies enable, hopefully, green hydrogen to have a significant impact on decarbonizing some of our most difficult to decarbonize areas. So with that, I'd like to formally welcome my panelists here, Alan, Emily, and Shayle, and thank you so much for joining us. And I'll pass the torch to Alan for concluding the panel discussion.
Okay, great. Well, Dan, that was great. Thanks for all this. It's a pleasure to be here. I appreciate the stock photo that includes the bearded bald guy. That is not me. So there's a lot to talk about here from all the data that you shared, and we're only going to get to a portion of it. So I'm looking forward to continuing these conversations. But first, I'd love to get something out of the way here. The elephant in the room. It'd be weird not to ask this. Dan, this is a question for you. It's been 3 months since the crisis at Silicon Valley Bank. How has the business changed?
Yeah, it's a great question, Alan, and I'm happy to have it. And I guess, I'd start my answer by saying that I'm grateful to be here, right? SVB has been a terrific place to work. I've worked here for about 17 years, and I'm happy to be able to continue to do that. So SVB was purchased by First Citizens Bank, and First Citizens purchased SVB largely because it's we serve an entirely new sector and one that doesn't have much overlap with First Citizens' existing business. And the First Citizens team has really been great in support of our business, and they're not here to re-architect it or reimagine it, re-envision it. They're here to support it. And so we have the financial strength of that entity behind us, and the financial strength as provided by the Federal Reserve Bank. And so business is operating as usual. That's the direction that we have, is to continue to deploy capital, continue to lend money into the sector, and continue to pursue our business as we did before, which we're happy to do.
One more question on this, then we'll pivot to the climate tech data. During the crisis and in the days after, there was, a chunk of business that walked out the door, layoffs the other month, talent getting poached. What argument have you and the team been making to try to get clients that SVB lost, or to hold on to the clients that are there?
Yeah, there's no doubt that the experiences of March has caused some damage to the brand, and some people have lost faith or lost some of the enthusiasm that they had for SVB. But what we do say to them is that we are here, we remain here, we're here to serve the community, to serve the industry, to provide banking services and financing as we always have, and we hope to re-earn that trust as the partner of choice for those industries that we serve.
Great. So let's talk about climate. Shayle, Emily, we just went through quite a bit of data. We've had time to sort of look through this. Let's talk about what you're seeing. Where are the areas that you find are drawing your attention, or that you're seeing a particular amount of activity? And by contrast, maybe areas that have seemed to have slowed down a bit in this space. And maybe, Emily, we can start with you.
Yeah, I think the data SVB has presented is pretty consistent with our experience, which is that climate tech funding has come down a bit, but not certainly at the same levels that we've seen in general technology. That being said, I think there's some interesting data that is also consistent with what we've seen with portfolio companies and other potential investments, which is, higher burn to revenue ratio, lower runway, and some signs that startups are at a point where they will need to be fundraising soon. So I think that's certainly notable as we look at the data. And then finally, valuations up across the board, across all stages compared to general technology, where that is only happening at the seed stage. And I think it's an interesting question of sort of, why are we seeing valuations increase even with slightly decreasing funding in climate tech? And I would say, one observation is that while some companies are choosing not to raise in this environment, a number of high quality companies do need to raise the kind of amount of capital to scale their technologies. And I think there is a willingness to pay a valuation or a premium on valuation to get in and be affiliated and invested in some of those higher quality companies. And then one last observation is just, I think a lot of funds, as we're seeing in the data, are choosing to go earlier. Certainly general technology investing, but also in climate tech investing. A lot of funds that typically would be sort of pre-growth or early growth are moving early or opportunistically investing in seed stage companies, which is inflating those valuations. And it makes sense, in an environment where trying to value a company based on multiples and revenue, when there's certainty around what that where that valuation and where that data settles, it's sometimes easier to go earlier to invest in a vision and a team, potentially at a lower cost of capital, even if there's more risk. So I think the data is pretty consistent with what we're seeing on the ground. And, I think similar to a lot of investors, we're encouraging our portfolio companies to, if they haven't already, extend runway and reduce burn to account for some uncertainty around when we might see a return to the fundraising levels that we did previously.
Sure. So diversifying to sort of mitigate some of that risk, moving earlier, investors getting more selective around companies that driving evaluations. Shayle, what about you? Are there particular, Emily was just talking about sort of the investment stages. What about sectors? Are there sectors that you're seeing within this climate space that tend to be drawing, it seems, more activity, or by contrast, maybe less so?
Yeah, I mean, I think everything that is right. I think at the high level, right, there are countervailing forces that are pushing against each other in climate tech. One is just the broader macro, which has been, deteriorating for tech and tech investing in general for a while now, sort of along with the broader macro economy, but not perfectly aligned and a little bit lagging. And then on the other end, you have these forces that are sort of more bullish, pushing on climate tech, which are a combination of, I think, general recognition that this is like a super cycle in climate tech, and just because we're in an economic downturn of some sort or another doesn't mean that climate tech is going to, and the need for climate tech isn't going to go away. In fact, it gets worse and worse with time. But also then you have this like supercharging force of the IRA in the US in particular, and sort of corresponding policies in the EU that have been coming alongside it. And so that's provided this big boost, and a lot of capital's flowed toward that. So to your point on sort of accelerating and those that are not, I think it would be interesting to break down, climate tech is, it's an invented category. Like, we're all a part of it, but it's not actually a market, right? It's a common theme amongst a bunch of markets. But if you look at which of the sectors within climate tech have seen the most dramatic expansion of capital allocation and startup creation, stuff like that, over the past year, I would bet you that there's a direct correlation between those that were directly impacted by these policies, by the IRA in the US and the European policies, and those that were not. So, like, as an example, right, big funding in the IRA went to, 4 or 5 sectors. Went to batteries and EV manufacturing and EV demand, went to renewable energy and stationary energy storage, went to carbon, went to hydrogen, went to probably one other, methane abatement, maybe something like that, right? Those are the categories that have gotten, that are getting the biggest juice from that bill. Those are also, I think, the categories where you've seen funding accelerate the most. In contrast, you asked for, sectors that haven't seen that. Some of the sectors that look a little bit more like traditional tech investing, or like, as an example, investors in consumer products, right? Broader consumer tech investing category has been affected just like the rest of tech. The types of things that sort of fall into the climate bucket, but are actually a consumer tech product, for example, alternative proteins, they've seen a real slowdown, right? So I think, if you really like dissect the data a little bit more, policy has had a huge role to play in it, just in how it's played out so far.
Yeah, and let's talk about policy. Let's talk about the IRA. I think that's slide 7, which shows how so much of these funding and commitments are being allocated, or excuse me, the incentives rather. Are we spending the money? Is this money being spent? Are these incentives being allocated in the right way?
I would say generally, yes. I think the breadth and diversity of the IRA and the distribution is significant. And if you look at the breakdown of these categories, it makes sense as far as also the size of the allocation is commensurate, I think, with the stage of the technology and the emphasis on deployment, for example, with electricity generation and storage. While also seeing breadth across other categories where maybe there is more of an R&D focus, that's the stage of where that technology is at right now. I think there's a couple areas in the IRA where we might have seen more funding because of the sort of dramatic capital needs of these types of companies, even if the technologies are still at an earlier stage. Long duration energy storage would be one of those areas where certainly strong tax credits and pretty significant allocation there, but I think you could have argued there'd be more funding for long duration energy storage over time. Also, transmission, I think there's about 500 million in the IRA, and projections suggesting we need something like 5 billion. So those would be a couple areas that I would mention.
And I think it's important to be clear. We have no idea how much money is going to come from the IRA and which sectors it's going to go to exactly, right? What the IRA predominantly does is separate from the infrastructure bill. The IRA predominantly does is provide tax credits, and those tax credits are uncapped in every case, basically. So what we know is how much any given thing is going to be subsidized. We don't know how much of that thing is going to be built, and thus the total size of the subsidy. So what we have here are some estimates that are as good as any estimates I think that we've got at this point, but I think it is assumed that we have very little sense actually over the lifetime of the IRA, which is a decade, right? These tax credits last through 2032. We just don't know how much of any of these things are going to get built, and thus how much the subsidy is going to be. So it may turn out that, for example, we build 3 times as much new clean electricity generation as is expected here. I don't think that's actually a crazy thought at all, just given how rich those incentives are, and how mature that market is, how quickly it's scaling up. That might balloon the total size of spending in the IRA, but it also might mean, that we do less carbon capture, for example, and that spending is less than expected. So I don't think we know yet. But what it does, the IRA does, is in those specific 5 or 6 key sectors, it provides huge demand pull in the form of project level tax credits. And in most of the sectors, it also provides a manufacturing push because there are also incentives for building that stuff in North America, or in the case of the EV tax credits and free trade agreement partner countries. And so what it has done undeniably already, because this is money that's being spent now, is it has dramatically boosted the US manufacturing capacity, or it will dramatically boost the US manufacturing capacity for all of these things in a way that's fundamentally different from how it was 2 years ago.
Sure. And that piece that you referred to about the uncertainty here, there's a flip side to that, right? We saw House Republicans during the debt ceiling negotiations try to defund many of these provisions. We're heading into an election year. How are you hedging the risk associated with the uncertainty of not really knowing what may happen with some of these tax credits and other provisions?
Well, I'll just say from our perspective, who knows? There's always risk. Any legislation can be changed by any future administration. So that doesn't change. I'll say historically in the US, tax credits are pretty durable when they exist. They don't always get extended, right? They expire at some point and they may not get extended, but it's pretty difficult to pull back tax credits that have already been offered. And in particular, in this case, as I said, what we're seeing happen right now is an incredible amount of new manufacturing getting announced, predominantly in red states and almost always with a lot of jobs attached. And so I think if and when the time comes that there's the powers that be in Congress and the presidency have any interest in a real full repeal of the IRA or any of the significant tax credits, there will be a constituency, perhaps surprising constituency to them, that I think will fight against that. Does that mean it's impossible? No, but just the combination of history and what we're seeing happen right now, I think provides some resilience.
Sure.
Yeah, I think we would feel similarly, which is certainly a risk, although we would feel optimistic about the possibility of the tax credits and the overall IRA remaining in place, regardless of the political dynamics. But I think we account for this risk in the same way we would a number of risks for a portfolio company, one of many.
I'd love to go to slide 8, which has the hype curve on it, which I love looking at this thing. And so much of this, of course, is inherently subjective on there, right? This is the one, we'll have it pulled up in a second, that shows whether companies are on the slope of enlightenment and the trough of disillusionment. Emily, maybe we could start with you. Are there particular sectors on there that stood out to you, either that you would want to relocate on that curve, or simply that you thought were worthy of talking more about here?
Yeah, I think it would be fun to talk a little bit about heat pumps. There's been a lot of interest in investing in heat pump companies. I think there's some argument to be made that they're maybe, while somewhat of a commoditized hardware product, there's still a lot of room for innovation and a lot of question marks around actual implementation of heat pumps at broad scale, both on the residential and industrial side. So maybe not quite sure we're at the plateau of productivity there yet, but I think it's an interesting place to talk a little bit about, because it is an area where there's a lot of interest, hype, funding. We have actually invested, and another sort of interesting narrative is I think there's a number of companies starting in the US that are going after heat pump innovation or marketplace models. But maybe a story that is less talked about is that a lot of heat pump growth is being driven by what's happening in Europe right now, which is that Europe saw over 40% growth in heat pumps last year. About this quarter, Q1, first quarter Q1, 110% year-over-year growth in Germany alone. Germany is considering regulating out oil and gas heating systems. By 2024, it looks like that will go through in some form. And so, you know, there's a lot of excitement around extending the vision of solar and storage and EV charging in an electrified home to distributed clean heat as well on the residential side, and then certainly a number of use cases on the industrial side as well.
Yeah, I mean, I think heat pumps is misplaced on this chart. I think in general, actually, I agree with most of the placements of this stuff, but heat pumps is, to my mind, like dramatically missed. Where on one hand, I sort of get it. Like heat pumps are crazy ubiquitous. I don't know if we realize this. We mostly use heat pumps right now to cool things, but they're in every car, for example, that we ever like. We use a ton of heat pumps, but we're thinking about this specifically in a heating and air conditioning capacity for buildings. For the most part, they are somewhat mature technologies. So I get why we think we're in the plateau of productivity. I don't think we really had a hype cycle before around heat pumps. We're in one now. Emily said it's actually way louder in Europe than it is in the US at this point, but so I would put us back in the sort of in the upward slope on heat pumps. I think we're going to see a lot of innovation there, both in the hardware and then the deployment models as well. And then, you know, heat pumps are actually a little bit broader range than people typically think they are. We just invested in a industrial heat pump company. So this is a company that makes heat pumps to decarbonize industrial steam. So their first pilot customer is a brewery, for example. So I agree on heat pumps. The other one that I think similarly is like placed a little too far.
Oh, we might have lost Shayle. Shayle, are you still there? All right, well, we'll see if Shayle comes back. Oh, there you are, Shayle. You're back.
I'm back.
You froze there for a moment.
I apologize. I was just speaking so fast it killed the bandwidth on my on my internet. Anyway, I agree with Emily on heat pumps. And the other one that I think I would put back in the earlier part of the hype cycle, even though this one maybe is on its second path through the hype cycle, is geothermal, which I think, you know, there's a whole wave of innovation around geothermal, both just like finding more spots for conventional geothermal, but then actually the kind of next wave could be enhanced geothermal, be super deep geothermal. There's a bunch of offshooting branches of geothermal where we're in the early days, not the end game. So I think I would put that one back at the beginning too.
Sure. I want to pivot to something that I've been hearing about quite a bit in conversations with both founders and funders, Emily and Shayle, and Dan. I'm sure this is something you hear quite a bit too. We had a roundtable out in San Francisco a couple months ago where there was a founder in particular who argued how startups that are focused in hardware, right? We're talking about hydrogen, factories, that kind of thing, are having a devil of a time all of a sudden raising money, and making the argument that there has been this venture model that coalesced largely around software, e.g. Facebook and Twitter, the last 30 years, and that this venture model is not well suited to hardware. This is a huge generalization that I'm making. There was a counter argument that it's not the venture model that's broken, that what we are now seeing perhaps is a correction in the sense that there was a lot of exuberance around many of these startups in climate tech, a lot of enthusiasm, and that there is a level of scrutiny that maybe wasn't there before, either because of the broader market chill or just in general. People are now asking more questions than perhaps weren't asked before. It's not a either or, yes or no, who's right question, but Emily, I'm curious sort of what you make of that discussion / disagreement, and to the extent that maybe it's one that you've even seen or been part of firsthand.
Yeah, I mean, I think arguably both are true in a way. I think just to share some context, we our first two funds invested much more heavily in hard tech. Our more recent two funds, I would say from a portfolio construction standpoint, lean towards less capital intensive companies, but we still invest in hard tech, probably just a smaller proportion of the total portfolio. So that's kind of the context I'm coming to this conversation with. But I think that you know, on one hand, it is hard tech companies that have great capital needs have to raise a lot more money and a lot more often, right? And there is a certain pool and a sort of growing, fortunately growing pool of capital and different types of capital for those companies, but that is just a reality, right? In addition, though, I think we saw a lot of investment in hard tech companies, which is great for climate. We need those solutions over the last couple of years, and a very fast pace of deployment, right? And so what we're seeing now is that perhaps there is a slowing down of funding overall. There's also, as I mentioned, a sort of an emphasis on quality, trying to invest in companies where you feel there's more certainty or more chance of upside. And so I think what some hard tech companies may be experiencing is, one, the slowdown, two, a sort of moving towards certain companies where there is a belief that they can get all the way. But I think there's a distinct difference in this market, which is that we have a number of excellent funds that are oriented towards hard tech climate companies in a way that we have not just had in the past, many of which have a sort of real a recognition around the distinct needs of patient capital for these companies, with a high reserve strategy to get them to the next stages of commercialization and beyond.
I agree with that, and particularly the last point. I think that the generalist VC community, and I would not include either of you two here today in that category, doesn't have a lot of experience in investing in deep tech, hard science technologies and the time scales required to do so. And investing in these kinds of things is much more akin to semiconductor investing or to life science investing that, you know, also share and enjoy that longer time scale for tech development. And so, you know, there have been waves of interest and investor enthusiasm in climate tech over time. And what I would say we're enjoying right now is the rise of that specialty firm, or the continuation of that specialty kind of firm, those firms that have a focus and a thesis around investing in this sector and a real understanding of the timescales involved and the amounts of capital involved in the space. And so you see, you know, non-traditional investors predominantly in the sector, and they have been the most steadfast in investing over time.
Well, speaking as one of those exact investors, right? So I lead what we call our Frontier Fund at EIP, which is dedicated exclusively to deep tech plus climate. So we're investing almost entirely in hardware, or hardware plus software. You know, if it's not hardware, it's pretty out there. But for the most part, it is hardware. And, you know, I would argue, I agree with everything you guys said. I would argue there's nothing wrong here. There's nothing broken. It is harder to build hardware companies. It generally is more capital intensive, though. Depends what you're doing in software world, right? If you're building like generative AI models, it's not any cheaper than hardware. But that said, it is capital intensive. It is hard, and I think, you know, but we think it can be a good investment anyway. And the reason for that, predominantly, apart from just the like macro forces supporting these trends that we're investing in, is that I think this is where the biggest prizes lie. But what that means is, in order for you to build a venture-backed hard tech or deep tech company, you have to be really clear about the size of the prize. The opportunity set has to be enormous. You can't sacrifice on that, because otherwise it's not going to justify all that time and capital expenditure that you guys are all talking about that it's going to take. And so you have to be taking a big swing, otherwise the math doesn't really work out. To your point, Dan, you know, traditional VCs do have experience doing that. They do it in pharma all the time. They do it in semiconductors all the time. Those things are capital intensive. They take a long time. They have binary risk. The difference is that they've grown accustomed to really understanding what the stage-gated risks are and what the promised land looks like on the other side. If you're building a new drug, right, you kind of can do a pretty good job of measuring the market opportunity for that drug and what your pricing power is going to be because your IP protection is clear. So you sort of know if it works, what it's going to be worth. Historically, we haven't had that as much in a lot of climate. And so that's where we've gotten wrapped around our axle a little bit with some investors coming in, investing in hard tech here, but not really understanding like what happens if this works? What does that actually look like? So we're very focused, at least this is part of why, to Dan's point, also like we're sort of specialist. We try really hard to understand what it looks like if it works. And that helps us get over the hump on what is undeniably like a monumental challenge that every one of these companies faces, going from 0 to 1 to 1 million.
Right. And I imagine too, asking not only what it looks like if it works, but what happens if we have to change our the business model or the business plan, which again, as I think, as you all alluded to, is much more expensive than reprogramming some software or just hiring a few different software developers. Dan, I want to ask you something about something that you mentioned earlier during the presentation, which is, I think, was on slide 10 about it. And forgive me if I'm misstating this, but I believe it was how a disproportionate share of firms or funds are making up a bulk of the deal-making activity. Is that right?
Yeah, well, in many instances, the top participants carry the lion's share of the weight, and that's true here. And so the statistic, I believe, is that the top 5% of investors in climate represent about 30% of the activity in the space. So climate has experienced a mushrooming of late that's highlighted in the formations in the peaks of the chart on the left side of parties interested in making investments into the sector, but the majority of the activity comes from a smaller number of dedicated specialist funds and individuals who are looking to make concentrated investments into the sector.
Has that pool, I guess, changed as we've in this sort of broader sort of macroeconomic environment we've seen? Do we know at this point?
I don't know that I've got great statistics on, the drop off of funds or the funds that are less active today. And I think that's at the heart of your question a little bit. But what I would say is we haven't seen drop off of the core of investors that are strong partners of ours that we see as active in the sector. And so all of those remain committed, remain enthusiastic, remain actively seeking new investment opportunities. So we haven't seen drop off in that way. And, I think, both EIP and the Wesley Group are strong and long-term players. And the Wesley Group has been active in the sector as long as SVB has been active in the sector, and they've remained, steadfast in their belief and commitment to the space. And, EIP is also foundationally, formed for the purpose of investing in the sector. And those are the kinds of commitments that don't waver in short economic cycles. And that's what we've come to rely on. That's what the industry has come to rely on, is working with solid partners who are committed in the thesis, not interested in the flavor of the day.
It feels like you can't talk about climate without talking about bottlenecks. We have a great question here from David Ty, and he asks, what you see as the biggest bottleneck and the best catalyst to enabling the transition, and if there's any detail on policy or innovations or structural changes such as permitting that might be helpful. And maybe Shayle, we could start with you.
Biggest bottleneck is transmission. Full stop. And then there's a bunch of stuff that flows from transmission, like interconnection as well. But like the way that I think about it at the highest level is simplest, like heuristic for how to solve climate change is cheap, clean, reliable, ubiquitous electricity, massive electrification of lots of things that do not currently use electricity, and then pick up all the pieces of everything else that you can't electrify with a combination of like clean fuels and carbon management. And you do those three things really well, you get to 90% decarbonization probably. That's totally reliant on the linchpin of decarbonization being ability to access and dramatically expand a clean electricity grid. And, right now we're just not doing that, particularly because we're not building enough new power lines, and the, process that we've got to connect new things to the grid, whether on the generation side or on the load side, are seeing increased wait times and higher costs and so on. So no question in my mind, if I could flip a switch and solve a problem, it is getting electrons from one place to another place. What can you do about that? The problem is it's a complex, multifaceted beast. And so I don't know that permitting reform is helpful, but it doesn't solve the problem in and of itself. So you need to do a whole bunch of things, but that's the knot I think we're going to have to untangle, because otherwise the what I consider to be the workhorse of decarbonization is just going to become a bottleneck.
Yeah, I mean, it's certainly two of the three arguably smaller, but one, I just think we're going to continue to need capital. Obviously, the Inflation Reduction Act is huge and significant. It's bolstered so much follow-on private sector investment as well, but we will continue to need enormous amounts of capital to fund and deploy these technologies that Shayle's funding, that we're funding, and that are benefiting from the Inflation Reduction Act. Two, we're on a smaller scale from a permitting reform standpoint. We need to continue to build out incentives and changes for how, especially utilities, procure performance-based incentives that related to permitting, incentivize demand response, virtual power plants, non-wires alternatives. That would be, I think, an area of continued opportunity and reform. And then finally, there's we look forward beyond the IRA, and it's this transformational climate legislation, what could be next, right? Even if it's not in the realm of political possibility right now. And I think, certainly more carbon compliance tax or something of the sort would be the next most significant transformational climate regulation, even if not feasible in this time right now.
Dan, anything you would add as far as the biggest bottleneck you're seeing?
No, I think the topics covered have addressed it well. Thanks.
So, Emily, you talked earlier about burn and runway. This question is from Eli, and forgive me, Oftedal. What are you advising companies right now? Should companies still be cutting burn, or is it too late at this point in the cycle?
Yeah, it's always an interesting conversation. It really depends the company, right? Investing in growth or right-sizing the business for where the market's at, and the realities of raising capital in this environment. So I think it's definitely a case-by-case basis. I think it's not too late for companies to make burn reductions and get more efficient. That being said, there are some companies, as we've talked about, that need to raise significant capital, and they don't necessarily have the luxury of reducing burn, at significant scale. Because it's not that simple, right? They need to build a first pilot manufacturing facility, and it's hard to reduce burn at that stage. So really depends the company, but I think we continue where it makes sense for the company to encourage those conversations around burn reductions, extending runway, given that there's still some uncertainty, even though the climate technology sector is doing better than general technology right now.
Sure. Yeah, Shayle, how are you and your team talking to your companies?
I think generally the way to think about it is what do you need to accomplish in order to hit what would undeniably be an inflection point in valuation? What are the milestones that are going to drive you to great success in your next round? What does it take you to get there? How can you get there with sort of the least resources possible? And depending on the answer to that question, as Emily said, sometimes that means you just need more time to get there, and that means cutting burn right now is probably a smart thing to do to buy yourself runway. Sometimes the only way that you hit that valuation inflection is if you spend ahead and get there, but then that comes at higher risk, and so you have to think about what that's going to mean and how you sort of structure your team in the meantime. But cutting burn is not like universally a solution to anything. All it does is buy you time. And so the question is, are you buying time to achieve something specific that you believe is going to drive you into a point of success in the next round? Obviously, the exception to this is because some companies are able to pivot to profitability. And if you're in that position, it's a nice place to be in if it's a decision that you can make. But as Emily said, if you're trying to build your first manufacturing facility or something like that, you're probably not about to be profitable. So, the most important thing is figuring out your sort of lowest risk path to valuation inflection.
We have a question from owner, and forgive me if I'm mispronouncing your name, who asked about alternative, the existence of incentives or stated incentives in the IRA for alternative industrial process startups, for example, decarbonizing steel, cement, industrial heating. Are there incentives for those types of processes in the IRA?
There are actually more in the infrastructure bill than there were in the IRA. The IRA sort of incentivizes a lot of that stuff indirectly because you get tax credits for your renewables or your hydrogen or your carbon capture. So whatever pathway you're taking there. The infrastructure bill did have a bunch of that funding, and that's flowing through now. So like, for example, there's a newly created Office of Clean Energy Demonstrations led by David Crane that's doling out some big grants. There's some grants going to actually decarbonizing industrial processes right now. So it's being fed through grant making through mostly the DOE. There's some for USDA as well, by the way, on the ag side. But I think most of that came out of the infrastructure bill, not the IRA.
This question comes from Boz. It's on the topic of the day, which is AI. Do we have a sense of the impact already that AI is having on decarbonization?
Yeah, we've been spending some time here. I think this would be my best prediction for what's next on the hype cycle from an investing standpoint. I think there's a couple interesting notes. One, some of the data I've seen suggests that generative AI models are 4 to 5x compute than existing AI models. Two, I think we're going to need a lot more data centers over the next decade. So there's certainly an energy opportunity around clean compute and data centers. I don't exactly know what that winning business model is or what that looks like right now, but I think there's some interesting opportunities there. But there's also a number of existing companies that have been using rules-based AI for years, especially around electricity hedging and displacing human trading desks with AI automated trading and a kind of longer vision of becoming a fully integrated retail electricity business. And I think that's where you're going to see some of these existing solutions that have existed. Maybe people haven't realized the full potential of them. And the recent attention to AI is going to put them in the spotlight around those use cases for maybe not large language models and generative AI, but existing rules-based AI applied to energy and electricity.
I agree with that. And I think, integrating renewables at scale, integrating EV charging, fleet charging at scale, demand response and modeling its impact. There's a ton of data coming out of our early stage implementations, and to be able to manage these systems, effectively, including all of the application of new technologies, is going to require not just the data, but the effective manipulation of that data, the testing of the data, digital twinning of what things look like when they're operating. And I think there's a real role for AI to play in the successful integration of all of these things into our economy.
So we're at time. Oh, I'm sorry, Emily, go ahead.
Yeah, I think it's an ironic topic because there's been so much going on in AI and climate and energy and EVs. And I think this is sort of the moment where some of that existing work will hopefully, be spotlighted and get more attention.
Great. So in the last few seconds we have, we'll go around and just hear what you're following, what we didn't talk about, whether it's a particular policy development, broader industry development, particular sector. What are you keeping an eye on in the days, weeks, months ahead? And Emily, we can start with you.
Sure. I started to talk about this when we were talking about heat pumps, but we are so excited about the historic Inflation Reduction Act, all of the climate activity in the United States, but we also have invested in some of the exciting activity in Europe as well. And so I think a sort of interesting narrative is that, not surprisingly, because of the invasion of Ukraine, rising energy prices, there is significant growth in solar storage, heat pumps, EVs and EV charging happening across Europe right now. Some really interesting companies. We're invested in a company called Voltaire that's a heat pump marketplace. We're also invested in a company called NPAL, which is probably the fastest growing residential energy company in Europe right now. So I think it's important to just remember that while there's huge tailwinds happening in the US, climate is obviously global, and there's exciting investment opportunities and innovation happening all over. I think Europe is one of those places that's really interesting right now.
Shayle, what about you?
I have a couple areas that I think are interesting. Well, actually, related to impact that AI is having on climate, let's talk about data center electricity load. Data centers are already a couple percentage of points of electricity load today, but I think expectations are now that's going to grow pretty fast. It takes a lot of data, which basically means power, to train these large language models. So that's a challenge for all the reasons we talked about before. Interconnecting big new load is tough right now, but they really need it. They're pretty price insensitive. They just got to get that stuff online. So there's a pretty interesting suite of opportunities around that. And then I would say, clean, distributed, zero carbon power, anything that delivers that, whether to a data center or campus or building or a house, and particularly if it can be dispatchable and provide reliability, there's still a huge opportunity for that. We're seeing it all the time. We're seeing it in the heat wave in Texas right now. So another big opportunity, I think.
Great. And Dan, I'll hand it off to you.
Yeah, we touched a little bit on geothermal. I'm pretty excited about the opportunities in geothermal, and I would sort of tack on to that nuclear just as another, significant source of sort of base load power that is low or no carbon. And I think those are really important things for us to focus on collectively. So very excited about that. And I would like to take the last seconds to just thank all of you, Alan, Emily, and Shayle, for joining me here today. It's really been fantastic to have you. Thank you so much.
Thank you. It's been a pleasure.
Thanks, everyone.